Hi, thank you for watching this video in which I'm going to explain you the difference between the free cash flow to the firm that we use in valuation and the cash flow available for debt service, which is more often used by creditors, such as in project finance, in which we want to know the capability of the creditor to repay the debt. Okay, they are very similar concepts. There is a subtle difference, and with a spreadsheet that I'm going to share with you, and then also you can download to follow up the video with your own enters. You can enter your own figures, and you can also see what is inside the cells. The first thing I want to tell you is that let me do this a little bigger. Okay, when we are calculating the free cash flow to the firm we use in valuation, we are interested in knowing which are the cash flow that are generated by the project or the company without any kind of debt, because we know that with and without that, the free cash flow is the same. So we want to calculate first the value of the assets of the company and then subtract the debt to calculate the value of equity, remember. But when we calculate the value of the assets, we don't care about if there is debt or not. We say that we calculate we discount with the weighted average cost of capital, the leverage cash flows of the company without debt, okay? That's why we calculate the taxes on EBIT instead of on earnings before tax. Okay, let me refresh you what we are doing here. This is a very simplified income statement. The company with that, right, in this case, okay, and then the tax rate is 30%. So we calculated here is not it should be 30%, right? Sorry, we should have here 30%, right? It's hidden, and then this is 30% times the earning before taxes, which is 13.8. Okay, so but remember that when we were calculating the taxes on EBIT, we calculated 30%, but on 51 earning before interest and taxes. Therefore, we were calculating a kind of more taxes than we should. So we are applying for the free cash flow to the firm more taxes than the actual taxes here. All right. So I think we're just I'm penalizing in the free cash flow to the firm that they use in valuation. For valuation, we are penalizing because we are computing more taxes. So what we are going to do now is to just skip back those taxes. All right. So as you can see here, right, the taxes we calculated are in excess of this amount that we call the tax shield, which is interest expenses times the taxes. Then, to calculate the cash flow available for the service, the most simple way to do it is to take the free cash flow to the firm, we already calculated, plus the tax shield. And the tax shield is interest expenses times the tax rate. So you have here, right? It's a very simple way. Remember that this was the free cash flow to the firm that we calculated. This is the same that I have here, right? And then there's the interest of that, okay? And then the tax rate is this one, and the tax shield is as you can see, the interest, nominal interest, times the tax rate, what we call the tax shield. That's the money you save. You avoid to pay taxes on this, the tax rate time the interest on that. And therefore, the tax shield is 1.5, and consequently, if we take the cash flow to the free cash flow to the firm plus the tax shield, simply we get the cash flow available for the. So what we do really is to add back the excess of taxes we calculated when we were computing the taxes on EBIT instead of earning before tax. All right, but still you can do another thing, all right, which is to calculate the taxes, the cash flow using the actual taxes instead of the taxes on EBIT, right? This is EBIT, taxes on EBIT, but remember that the actual taxes, the taxes on earning before taxes are 3.8. So if I do, calculate here this, my operating cash flow is EBITDA plus 050, which is the operating working capital, plus minus the taxes on EBIT, right? What I get is the cash flow available for the services, which is the operating cash flow minus plus investment in that case. All right, so what I do actually is to compute the taxes over here, right? Operating cash flow is 043, which is the EBITDA, plus 050, which is the operating working capital, plus which is minus taxes, all right? And then that will be the cash flow available for the service. So I can do two things: to take the free cash flow to the firm and add the tax shield, or if you prefer, to just calculate the cash flow, but considering the actual taxes you paid, not the taxes on the EBIT. You will get exactly the same result, but I advise you to do in the second way because it's much more, it's faster, all right? Okay, thank you very much for listening. I hope this clarifies the relationship between the free cash flow to the firm and cash flow available for the service. Very similar concept. The difference is the tax shield, which is interest expenses times the tax rate. Sometimes this is negligible, sometimes it's not relevant, but still theoretically the analysts that are performing valuations use the free cash flow to the firm, whilst the analysts that are credit analysts that want to know the capability to repay the debt will use the cash flow available for the service. Okay, as you can see here, at the end, I can calculate the free cash flow to equity, which is after just the debt, what is going to go in the hands of the equity investors, the shareholders, can be calculated by taking the free cash flow to the firm minus the effective financial expenses, not the nominal effective, because you save the tax shield. So you take 30.7 minus 3.5, and then you get the free cash flow to the equity. The other way to do it is to take the cash flow available for the service and then subtract the actual nominal interest expenses. So cash flow available for the service, my nominal interest expenses minus change in the nominal amount of the debt, obviously, it's equal to, say, free cash flow to the firm minus the after-tax financial expenses. Thank you very much for listening. See you soon.